Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Thursday, March 13th, 2025. Today's episode begins with our headline: Stocks tank, fear not maxed out, and metals shine. The S&P 500, the SPX, dropped by 1.39% today on a closing basis. And from the recent all-time high in the market, we are now down over 10%. This is correction territory. From 10% to 20% is correction territory. Below 20% is then bear market territory. It adds fear, and it says that we may be headed lower. I say that fear is not maxed out yet, partly because of this Fear and Greed index from pyinvesting.com. Currently, 27% of stocks in the market are in an uptrend and are above their 6-month exponential moving average. And while it seems like the market has been just falling off a cliff, this is not even as low or as fearful as October of 2023. Not as low as June of 2022. There's a lot more room for this to continue to the downside. To emphasize how far the greed level can drop, at the very bottom of the Great Financial Crisis, the greed level was only at 3.9%, while today we are at 41.5% greed. So while fear is here, it's not maxed out yet. Another way to look at this is bringing up the advanced decline line, something I've been bringing up in a lot of shows lately. Obviously, it's lower today. It gives confirmation that this is going down and this is likely to head lower. And we're not even at the bottom of, the past year in the advanced decline line. The second main part of today's headline: metals shine. And I don't just mean some metals, I mean all metals. Dr. Copper, with a PhD in economics, being an industrial metal, this is today's candle, the big green one here, not this one. We went up by 1.65%, all while the S&P 500 is absolutely collapsing. While there are tens of potential narratives that you can put on copper, I mean, is it China that is buying copper here? Are we worried about escalations between countries? Are we worried about tariffs? Are we, there's a million different things that we can attribute this to, including just chart patterns. We haven't even gotten to the high of May of 2024. And that's, almost a year ago, the price of copper was much higher. I have no idea, but it's interesting nonetheless that copper is getting a bid here alongside silver, also going up 1.9% on today's candle, above notably all these previous highs. We haven't seen this price this high since October of 2024. And then gold, of course, as well, going up to new all-time highs? Yeah, it is. A stone throw away. What is this? $12 away from the $3,000 level. What was the high? Oh, we even hit a higher high just recently after this candle. What's the high at? $29.90. Yeah, so less than $10 away from 3,000. I mean, it's pretty clear we're getting to 3,000. Will that mark the top? Maybe, I don't know. But yeah, this previous bull flag that I drew on here played out as I expected. This little thing here I had previously drew, I think, as far back as maybe March 4th. And so it is playing out as expected. So we have a lot of fear right now in, the valuations of companies, with these enormous PE ratios going on. You can't be surprised that if there's even a hint of a slowdown, that Mr. Market, it would make sense for him to slam on the brakes here. So yeah, we're probably seeing a little bit of that, along with unsureness about potential further inflation, is what the metal markets are saying to me. And that does involve tariffs being somewhat inflationary. This is probably a good point to bring up an overarching theme that's very important to understand about Mr. Market, and something that Benjamin Graham said a long time ago, and this especially applies on a day-to-day basis, being that the market is not a weighing machine, it is a voting machine. And it was later added by people that supposedly heard him add to that, but eventually it is a weighing machine. And that part does make sense, because the longer view of it is like things balance out. If things get way out of balance one way, eventually they're going to come back into balance. You know, gold can't have its price super suppressed or super overvalued forever. Same with Bitcoin, same with .com companies, same with housing, same with anything. There's a lot of power in reversion. But that's a little digression. The main purpose that I'm trying to say is that, you know, we have these narratives about what's happening day to day. This is just Mr. Market being all crazy, you know, on a day-to-day basis. And it's good to, you know, zoom out a little bit. And that actually kind of goes into the first community topic that I wanted to bring up today. But before we get there, I just want to get through the rest of the main headlines for today. Next one being that break-evens diverge from metals. Again, if you want to know what the market is pricing inflation to actually be at, look at the 10-year break-even inflation rate. Tanking again today to 2.29%. This is what the market expects inflation to average over the next 10 years, and is betting heavily on it in this market. If we saw higher highs in this, you know, than what we've seen maybe in the past 5 years, the peak of this was in April of 2021 at 3.02%. If we saw higher highs in this would be more concerning to me regarding potential future inflation. And right now, on a very short term basis, you know, from February 20th, we've been spiking down in expected inflation expectations. Next up, we have PPI and initial jobless claims. Not much to see. If we were in the storm on a weekly basis, the actual number would be spiking here. 220 is not crazily high. And then the PPI, I mean, month over month, this was quite a bit lower on the headline, expected 0.3% month over month, and we had no increase in producer price index, and the core dropping from 0.3 to 0.2. This is the better one to look at, the PPI, because obviously the headline PPI includes the food and energy. And then, year over year, 3.2%, 3.3%, headline and core. So next topic, someone wrote a comment saying how dividend yields are not a good indicator. I agree with this, and the point, though, that I'm trying to make with it is simply that the potential downside in stocks can increase when investors look at what the actual return is on their investment, what they're getting paid, you know, and demand a higher dividend yield. Since the 1990s, since 2000, you know, has the idea of a stock, has the idea of owning a business, has the whole formula changed completely? I have my extreme doubts. I think that we've been in sort of a bubble since really the year 2000 that hasn't popped yet. When you have companies that are, yes, reinvesting money that's coming into a company in order to make more money is a good, positive thing. But I think there does need to be limits there. You know, you're essentially taking power away from the shareholders, because what you're doing is, you know, when companies used to offer, in, let's say, a normal amount of 5% dividend on your stock, the stock owners have that option to buy more of your stock, or buy a different stock, or invest in something else. This automation of you owning a stock, and therefore now you own a bigger company, and now you own a bigger company automatically, this is scary as heck to me. It's it's irresponsible corporate finance, and I think it's been going on for too long. With 150 years of stock market history in the U.S., with only the past few decades basically showing, no interest in paying the stockholders out their money, and just, what are they relying on then? They're relying on other people to buy their stock at a higher price. It it sure sounds like a Ponzi scheme when things are getting like this. So anyway, I just wanted to bring that up quick. I don't want to talk about it too much today. So I agree, it's not a good indicator, especially of like very short term things. But the fact that we're at all time lows in 150 years, the companies have never paid the shareholders less money. That should be a little bit of an alarm bell to everyone out there. Another person brought up HYG. If you've been watching the show for a while, I have about 2% of my whole 2 or 3% of my whole portfolio sitting in put contracts, put leaps on HYG. It's a high yield corporate bond fund. I don't often bring it up, partly because, let's see, is this adjusted for dividends? Okay, now it is. It's down here in the corner, ADJ. Only because what it does is it takes out the down days from the dividends. Sometimes that can confuse the chart because you'll get a big drop in the price from the dividend, and this takes that out. So anyway, yeah, HYG dropped today. It looks like a big candle. It's only 0.56%. Of course, in the bond world, that's a bigger deal than, that much movement in a stock, obviously. I usually bring up just the high yield corporate bond spread, the Bank of America one, because it tracks more of the junk bond market. It kind of gets a bigger snapshot of it. HYG is it's a managed fund. And so there's a guy that they hire that picks and chooses bonds that he thinks are safe or have more safety than, what is needed to pay for the bond coupon. And so to get that advantage. So, the best fund manager of something in high yield corporate would never see losses. They'd never see any missed payments or bankruptcies of the bonds that they choose, because the whole point of a bond is safety. So that's why I like to use the overall junk bond credit spreads instead of just looking at funds like HYG, or HYT is another one that I like to look at. But it can definitely help us see the pictures. It is a chart I check every day, and it's been falling down along with credit spreads obviously widening here. And if you have puts like me, it's going in your favor. So, good job, Robschild and Robschild followers, if you're invested similarly to me. At least for now. Remember, guys, you're always watching. I never give any advice on this show, and you're literally watching a guy who has a pet dragon and a crystal ball in front of him. Looking forward into next week, we have Friday, the consumer sentiment report. Of course, we have Wednesday, the FOMC decision. And the bigger thing is really, there's like zero chance of a cut right now anyway, priced in. I mean, heck, if tomorrow we get like a 10% down day in markets, who knows? We might start seeing, a potential cut coming way sooner than anybody thought. But so that's on Wednesday. We'll see what happens. And then the next report after that is, Friday, the consumer sentiment report. Really good leading indicator. Before we get onto the charts, again, thank you for watching, subscribing, and supporting. Please subscribe if you haven't yet. I'm trying to get to 1,000 subscribers. Once I have that number, I'll stop asking you to check if you hit the subscribe button, I promise. At least for a little while. I don't know. And yeah, the support overall on the channel has been incredible. Thank you for all of the support. Watch Macro Update 21125 to hear me explain the daily reminders. We had one little update today, just the CAPE ratio dropping now to 34. It's like 0.47 or something like that today. Still very high, okay? And the dividend rate actually going from 1.3% now, rounding up to 1.4%. But other than that, all the rest is the same. I'm still in the same boat right now. That may change soon, but not yet. And I am still solidly in the same space for my crystal ball ratings in my portfolio. Hear me explain all of that in Portfolio 21125. On to the chart, starting with the Russell 2000. While the S&P 500 has just entered correction mode, the Russell 2000 is playing with bear market mode, down 18.9% on a closing basis from the intraday all-time high. I don't even know if that's an all-time high. I just want to remind everybody that, over the past many months, I can't tell you how many people I've been hearing saying, oh, capital is going to be rotating now from the larger caps into the small caps because the small caps have lagged behind. So this is on an unadjusted basis. This was almost an exact double top, a very bearish indicator, especially after hitting the double top and just absolutely crashing down here with what essentially is from November 26th, dropping a bear flag and playing out exactly as that pattern normally does. What I really can't believe is that we even got back to all-time highs in the Russell 2000 recently, and I'm not surprised at all to see it selling off here. Just another pattern, by the way. What can end up happening is if this ends up turning into an M pattern, basically from here down to here up to here, if we break below this line here, the typical thing to play out would be to go from this neckline here to the top and drag it down to where it would crack. And what does that look like? A price in the Russell 2000 of, IWM, the ETF that represents the Russell 2000, a price of around $90, very notably below the COVID low, below 2016. If this pattern were to play out as may be expected, we may be going back to prices perhaps not seen since 2013. This would be an enormous drop. This would represent a 63% correction in small caps. It's unreal how greedy markets can get, and on the other side, on certain occasions, in certain years, in certain scenarios, it's unbelievable how cheap things can get. And that's the time to get excited. When everybody thinks that the world is falling apart, that's when it's time to scoop up shares of everything you can get your hands on like there's no tomorrow, and with leverage, maybe even as much leverage as you can afford. I also wanted to share ARK. ARK-K, this is the flagship, the main fund of Cathie Wood's fund that became really famous post-COVID for having such an enormous run. While it looked like we were getting back into very healthily bullish mode in this, I was like, whoa, am I really missing out on this next wave of innovation stocks going to the moon? Yeah, we're down 31.4% intraday candles. This is well into bear market territory. I guess investors need to start asking themselves, is this a buy the dip opportunity for ARK funds? I think that it can drop much, much, much lower, but you never know what Mr. Market will do. And if we get a snapback on this, that could be a very good opportunity. I don't think I'm going to do it. It does look a little tempting seeing it drop 31% so quickly, though. The VIX, how options are priced, actually bounced today, notably not higher, but more than anything sideways, I guess. The most important part of this is that we're still above 20, and so we're still in screaming fear mode. And just to add to the headline here, let's scroll up, that the fear is not maxed out yet. The VIX can and often does certainly go much, much higher. You just take a look at the Japan yen carry trade blow up, getting up to 65. We're only at 24 right now. The COVID crash getting up to, what is this, 84, and other shocks. Let's see, the Great Financial Crisis peaking at 96. So more potential fear ahead is very much still in the cards. The last chart of the day, I mentioned this earlier in the show, the junk bond spread, the Bank of America, high yield index option adjusted spread, took a tiny bit of a breather. Again, this is updated for the last day, so we won't get today's data until the morning, but certainly with the stock market continuing to fall, I expect to see a higher spread for today's data tomorrow. Credit spreads, sometimes they stay muted while stocks are falling, and that means that the credit markets aren't worrying so much. But when the credit markets are worrying and spreading, again, we're not at max fear yet. You want to see how wide credit spreads can get? Well, let's do that before I go. Again, you max this chart out, they spread by almost 20% in the bottom of 2008. 20% difference of what you could get on treasury bonds versus junk bonds. And right now, we're only at 3%. The amount of potential downside in the markets is enormous. And just for the CAPE ratio to get to a somewhat normal valuation, it wouldn't be unexpected to actually drop in the S&P 500 50% from today's price. And I don't mean that sarcastically, and I really don't mean to exaggerate. These are very strong possibilities. Stocks can and often do go even all the way to zero, believe it or not. And when companies, have contracting earnings, we're looking at potential negative GDP, which is typically associated with lower earnings. It makes the PE ratio, today's PE ratios, look even more expensive, because if you have the actual earnings shrink, then that amount is even a smaller portion of the price. This could potentially be a very long and hard ride that gets a lot of people very off guard. But, what do I know? I'm just a guy with a crystal ball and a dragon. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching. Click the subscribe button. I want 1,000 subscribers. And I'll see you next time. Robschild.